Good morning, good evening, good afternoon, whatever time it is wherever you are right now, and welcome to another session of Bizarre Financing. I'm Gordon Bizarre, and today we're going to take up 18 great questions that have been submitted by members that came in after the webinars were over. And so we didn't get a chance to answer them there, but we selected these 18 because they're questions that are actually quite common. So let's just dive into it. Even though we're doing questions and answers today, you may have questions about the questions. You may have questions about the answers. So if you do, please jot them down or type them into the question box on the right side panel, and we'll get to them. And of course, if you raise your hand, we'll have the opportunity to talk to you live and in person, and maybe even drill down on the question even better. But if you don't get an answer to your question today, or you still have questions about the questions or the answers, send us an email at question@bizarrefinancing.com. Let's take the first one. What are the advantages and disadvantages of the earnout payment method for both seller and buyer? We use earnouts a lot today. And the reason that we do is because the purchase price on businesses is actually now, and I'm going to use this word, artificially low. Meaning, if you're out to buy a business today, because of the high interest rates, money to buy the business is expensive. Therefore, the price isn't as high as it would be if interest rates were low. The competing value of money that is high priced to a business, people would rather invest, for example, in a high return asset that was relatively secure, like a bond or something that returned a high rate of interest, than own a business which has a lot of risk to it. And so in the money marketplace, the higher the interest rates go, the lower the multiples of earnings that you're able to price a business at that you're interested in buying. Now, what that does is it takes the seller to a place where they had this anticipation that when they get retirement age, that their business was going to be worth a lot of money and that they would have the ability to retire comfortably because of the asset value of their business or its selling price. And they're disappointed today because the offering prices on these businesses is nowhere near what the expectation of the seller was. Then the next thing that happens is that the money again is so expensive that even at the lower value, unless a buyer has very deep pockets, they can't afford the money cost. So the amount of down payment that people have the ability to pay and the willingness to pay is relatively low compared to the purchase price. So that's the realities of the marketplace out there. So when we are talking to sellers, recognizing those two sets of limitations, we approach them with an earnout formula for the purchase of the business. And it looks something like this. Take a business that, let's say, had an EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, which is the basic cash flow of the business. And that business is going to be worth some multiple of those earnings. Let's just use a modest one of 5 times. And you have a business that's earning $1 million a year in EBITDA, and that it's worth 5 times EBITDA. It's worth $5 million. But you're not going to see any offers in today's market where a buyer comes up with $5 million in cash for the business. You're probably not going to see a buyer who has the ability to put $1 million or $2 million down and then borrow the rest at today's high interest rates. So the seller's got a problem of how do they get their value out of the business. We've actually developed a formula for making offers on these companies, which is very good for the seller. I'm going to describe it to you exactly what it looks like and how it works. But the thing that I would like you to understand is I personally am not interested in buying businesses where the owner isn't going to stay on for 3 to 5 years to run the business after the purchase. If the owner has waited till the last minute, they're sickly, they're 80 years old and they're tired and they're worn out and they're sick and they're all that stuff, and they've got to sell. They waited that long. They got a problem because the value of that business is in the person who built it, who understands it, who has made it grow all these years. And so you want to preserve that asset of the business because if that person leaves the business, then all those great earnings that are the basis of the value of for which you're paying for the business is going to leave very shortly after you bought it. So you're not buying the real earning power of the business if it doesn't come for at least a fairly decent period of time with the person who's producing those earnings or is the one making sure that those earnings are taking place. So I don't buy businesses at that state. I buy businesses from folks maybe in their 60s that are looking to retire. They got 5 to 7 to 10 good years left in them, but they want to start phasing down maybe a little bit, taking it a little bit easier. And they make perfect people to run the business because we can support them with additional personnel where over time we groom new people to take over the business who have the capability to keep the company growing. And that's, of course, what we're looking to do. So what we offer that person is an earnout. So we tell them, we know that you were planning to sell your business for 6 or 7 times EBITDA. And at that multiple of earnings, that's what gives you the value of the business that you were looking for. But in today's market, it's not worth that. So what we're going to do is we're going to give you 2 bites at the apple that are going to give you money now and give you the opportunity over the next 3 to 5 years, however long our agreement with them would be, to move the earnings up, and we'll share that growth with you so that when it all comes out in the wash, you've actually sold your business for 6 or 7 times EBITDA instead of only 5 times EBITDA. And then we set the price at, let's say, 3 to 5 times EBITDA for what we're buying now, because that's what we want to pay for it. But then we give them an earnout that as they grow the business over the next 3 to 5 years with our help, they'll have received enough in the earnout bonuses that they will actually have received an amount of money that was equal to had we bought the business now for, let's say, 7 times earnings or 6 times earnings. So it's that kind of formula that gets them very excited about it. And we technically have to come up with less money because we're valuing the business now at, let's say, 3 or 4 times multiple, which is the real value of what it's worth in today's marketplace, not 5 times. Then they get a certain amount of that as cash now. And then the balance, they're going to have an earnout formula that takes care of that. Also, we don't buy them out in full. We buy out 80% of the company. We leave them owning 20%. So when you go through our whole formula, there's only a modest amount of cash that has to come up at the beginning. And with some combination of earnout, with all the bonuses they get through that, and then the fact that they continue to own a piece of the company, which based on its then price 3 to 5 years from now, the same formula we use to value the company now, we'll use to value the part that they still own then, but then it will be producing a lot more sales. So that will produce a big chunk of money for them. And then they also have the benefit of perhaps in order to keep our cash part of our purchase price down in the front, there may be a note for part of the purchase price, which is technically seller financing. So those are the 3 elements that we bring together. And we bring through that, we bring the cash portion of what we have to come up with. The note from the to the seller is at a relatively low interest rate compared to the general marketplace out there. So when you look at our costs of acquisition, they're actually very low. And the seller is happy to, in effect, carry the low cost to us because of the future high return as they grow the business and have that second and third bite at the apple with all the things that we're pushing towards the end. So the 2 things happen for the seller. One is they get a good chunk of money now. They get income for the next 3 to 5 years that's respectable, livable, works for them. And then as they get the buyouts and the earnouts cashing out at the end of that period of time, they actually end up with the money that they need to secure their retirement and give them the financial security that they thought they were going to get. But in today's market price, it's not enough to give them that with a cash out. So it works for everybody. And there are definite advantages to the seller, and there's certainly advantages to us as the buyer. Now, if you have questions about this, please write them down. And before the end of the webinar today, please raise your hand or put them in the question box. And one way or another, we'll get as deep as you want into what I just described so that if there's any gap in your understanding, you will understand it hopefully by the time we're all done. All right. Our next question. How long is a reasonable handover, or some people call it a transition period? If you buy small businesses through a business broker, you're going to find that generally the seller will stay on for as short as 3 weeks if it's a real small, simple business, or maybe up to 6 months to provide for a transfer of the knowledge that's in their head over to the buyer. And I don't buy companies that way because there's no such thing as transferring 5, 10, 15, 20, 30 years of building a business, however long they've been doing it, into the head of a new owner in that short a period of time. And it doesn't matter how much experience the new owner comes with. There's going to be elements of the past operation of that business that they're simply not going to understand. And I don't look to buy businesses, number one, that are small enough where the owner's inside knowledge of the company is existential to the business. because otherwise the new entrepreneur has to go in, replace the owner, and you've bought a job. You've bought something that if you're not there running it after the seller leaves, it's not going to make money for you. The first thing I want to do is differentiate between a very small business, which I never recommend buying because you're buying a job, to buying a business that is substantial enough that and maybe the definition for our purposes here today is it's big enough to have a management team running it, which is a business today that would be at least in the 7 to 10 million a year in revenue range. And so at that point, you've got either a good vice president or somebody who's an acting president. The seller's his co-chairman and maybe only comes in 2 days a week. And he's got a good professional group running it, and they're capable of running it after the seller leaves. All right. But even a $7 to $10 million business has still been built by somebody who really is the hands-on person that built it. And that's the person I want to preserve. So even there, I want to see a 3 to 5 year transfer period. And that to me is the handover period. Again, a lot of businesses that are sold by brokers that are small, they all want these really short handovers. And you're not buying a real business. You're buying a job that the seller is going to transfer what's in his head to you. And after that, you go to work every day, you roll up your sleeves, and it's all up to your ingenuity to run the business with very little of the expertise having really come out of the seller's head during that short transition period. Hopefully that answers this question, gives you a little bit better insight into the underlying rationales regarding a handover period. But I like to buy them where the seller's going to stay on for 3 to 5 years. They're going to run the business. It gives me time to groom a talented person underneath them for that period of time so that by the time they do leave, we've got somebody that knows that business inside and out. We've had a chance to really qualify them. We may have gone through 2 or even 3 different people during that period of time to having found the right one to really continue on with the management of the business. So it's not a simple process. You need long times if your business is of any size and complexity. All right, so much for that. Number 3, what would you say is the minimum and maximum valuation on a business with 3 or 4 staff members turning over 250K with no manager in place to continue running things on day one, unless I bring in someone? All right, that is a composite of the question that I just answered. You think about it. Okay, first of all, we got to define 250K. Some people refer to turning over or turnover as the gross sales of the business. Other people might look at that and say, well, that would be a very tiny business. So turning over in this case maybe means the cash flow or the profit of the business. Let's take it both ways. If that is the gross sales of the business, do yourself a favor. Do not consider this business. Walk away and just thank your new insights for the fact that you will not be wasting your time buying a business that's not even worth its transaction costs. Okay. Because this is not a business that you should be even thinking about. Then let's look at the other definition, which the 250K is earnings. Now, what kind of earnings are they? Are they the total earnings of the business and that the seller uses part of that to live on? Or is that the earnings of the business after the seller has taken out his living needs from running the business? And that's true profit. All right. If that's part of the earnings of the owner, again, do yourself a favor, walk away. It's not worth your time. The cost of the transaction, the time, the effort, the opportunity cost of putting your energy here instead of it to something much more viable, it just simply is not worth it. If it's 250K after paying for the seller's living needs and it's a decent lifestyle that it's paying, all right, at least now maybe you're looking at something that's worth its transaction cost. But again, there's nothing there at that level that you should get excited about. It's not going to make or break your future. It's nothing that you're going to want to be committing your time to. And the only justification for it might be that it's very hard to start these businesses of the kind that you want. It takes a long time to turn the corner and get them profitable. But once they're profitable, now you can grow them very fast. And this then is just a shortcut for you to get to that point. That would be the only exception that I would have for looking at this business. But in any event, what would you say is the maximum or minimum valuation? I don't put it in terms of dollars. I put it in terms of your time. The minimum amount of business that's going to justify your time and start to think this way is a minimum that after it pays you a good living is earning $1 million a year in profit. That's the minimum that you should want to go after. And there is no maximum. But the maximum on these businesses here, with these numbers, simply doesn't exist. It doesn't even cross the threshold of being worth your time. So if you're looking for a teeny tiny business, I need you to reposition your thinking. I need you to start thinking of yourself as you're too valuable, you know too much, you have access to too many resources here at Bizarre Financing, and you have too much knowledge and passion to waste your time on this. You should be shooting for those businesses out there that are of a decent size where you can make a good living out of them, number one. But number two, you have a business that's self-generating in its ability to grow. It's got management. That management is capable of improving and increasing itself and growing and increasing the business. So that's the minimum that you're looking for. This is another handover question. It says, would the handover period be expected as part of the deal? Or would you expect to pay the owner a consulting fee on a day-to-day basis? If you're paying the going concern value of the business, then that includes the know-how of how to run the business. You can't sell a business without know-how of how it runs. So if I'm paying the going concern value of the business, then I'm expecting that seller to stay on for 6 months, a year, whatever it is, not pay him other than for the actual value of his work to the company from that point forward to help make it grow. I'll pay him for that, but I'm not going to pay him to transfer past knowledge to me because that's part of what I'm paying the purchase price of the business for. That's why the business has goodwill. That's why I'm paying the goodwill valuation of the business. Now, sometimes that totally contradicts the seller's expectation and they might even get mad at you for not wanting to pay them for their time. That's not an argument you want to have. So here's the way you can think about that. That part of what you want from that seller is the goodwill you're paying for, but he doesn't want it that way. So give it to him the way he wants, but then reduce your purchase offer in terms of what you're not getting because they haven't transferred the good value of the business to you. You're going to have to pay for it later. And you do it dollar for dollar. So if he wants to have be paid over the next 6 months, $50,000 or $100,000, if you reduce the purchase price by 100,000, but now you pay him month to month to month, you just created some deferred payment for the business. That's number one. Number two is it's better for you tax wise. If you pay him as purchase price for the business, you don't get to deduct that on your taxes. If you pay him as salary or consulting fee, that's deductible. So you just created a tax deductibility for part of your purchase price instead of having to pay that part of the purchase price as after tax income. And then from the seller's point of view, if he had taken it as purchase price, he would have been treated on that 100,000 as capital gains, which would have meant he paid a low rate of tax on that 100,000, as opposed to as salary, depending on what tax bracket he's in overall, he may pay a lot higher than that in terms of tax rate because he took it as income instead of purchase price. And so the question is, you try to give it to the seller in the way they want to see it, that way that makes them happy. And on your side, you have to look at it as a trade-off between purchase price and paying for the seller to stay on for a period of time. Now, I'm differentiating here to the seller who's not staying on to build the business with you. Okay. We talked about that a little earlier. We're talking about the seller who's transitioning ownership to you. You're coming in to run the business and he's transferring the ownership knowledge to you. And you're there to build up the future of the business. That's a different story, right? That's what we've just been talking about. That's adjusting purchase price in it that you're taking away there and pushing it over to this thing called handover or transitional consulting from the owner. So that's the way that I look at it. Also, it's not uncommon, aside from this description, to have a seller who, again, knows a lot about the industry, a lot about the business. You've built up a lot of goodwill and cosmic bond with the seller. You really see him as a resource for the future. Got a lot of information in his head about the industry, well beyond just what it takes to run the business. And you may want to have a real live ongoing consultant agreement with him that maybe goes out for a couple of years so that you can consult with him and you pay as you go, right? In other words, if I use X amount of your time, I pay you Y amount of money, but you're available to me to help me understand and pursue the business in the future from your knowledge of it, having run it all these years and being involved in the industry. So hopefully those little nuances and differentiations make sense to you and you have a decent answer for this question of what would the handover period be expected? Would it be expected as part of the deal? And, or would you expect to pay the owner a consulting fee on a day-to-day basis? Okay. There's a lot of nuance around the answers that I gave you there. Number 5, Is it advisable to set up a holding company or use an existing business to purchase the new business? Now, I'm going to read the second one thing, and I'm going to come back to the first one. And would it be a risk to use an existing business to buy a new business because the new business may have toxic assets? So when this question was written out by the person who had it, they really almost half answered the question in the last part of their question, because you do not want to use an existing business to buy the company, because if it has any losses, if there's any risk, if you've come to a place where you can't make payments and you don't want it impacting your existing business, you got to do it where it's totally separate. I never expose an existing business to a new business and take risks that the new business is going to be successful and not interfere with the needs and the cash flows of my existing business. So back to the first part of that, is it advisable to set up a holding company? Some people call them holdcos or holding companies, but the real name for them are called special purpose entities, SPEs, or special purpose vehicles, SVs. And what they are is they're a brand spanking new company that you set up to be the buyer. And your existing company, or you personally, it could be you personally too, but it could be your existing company that owns the SPE. So now you've created a cutoff at the SPE risk of buying the business. So the SPE is at risk, but you or your company as a stockholder of the SPE or as a percentage membership owner of it, if you set it up as an LLC, you have insulated your existing business from that risk. So that's the reason that you use SPEs and SPVs. And also they make the purchase very clean for any investors that you have. So for example, if you bought the company with your existing companies and you needed investor money in order to complete the purchase, now what do? Give them equity in your existing business? You don't want to have to do that. You would rather have the deal well done and stand on its own. Your investors own stock in the SE or SPV. Okay, they own stock there, but they don't own stock in your business. All right. So you get the company financed based on the company's viability, and you do it where all of the buying resources are the product of your SPV or SPE. Okay. So hopefully that makes sense to you. But the answer to the question is you never buy a business in your own name, and you never buy a business in your company or have your company be the buyer, existing company. And if you buy 100 companies, same thing. Every company gets its own SPV or SPE. Okay. So that way you're never exposing your existing businesses to the risks of the business that you're purchasing. All right. Next question. How do you get around sellers or brokers asking for proof of funds? That's not a problem for you as a member of Bizar Financing. And the reason for that is we have what we call a proof of funds letter. National Diversified will provide for you that is addressed to the broker that's asking you for the proof of funds. And it'll say something along the lines of a brief statement about who we are, the statement about the agreement that we have with you, and that we are providing resources for the purchase of the company. And it answers that question of, is there money available for the proof of funds? We've been supporting our members with those letters for going on 35 years now, and it completely knocks off the table the request for proof of funds. The whole idea of proof of funds is what happens in the world of business buying is a lot of people are trying to buy businesses that they simply are not qualified to buy. They don't have cash. They don't have know-how. They don't have any resources available to them. The most important of which is the know-how, how to get investors behind your project, how to create a structure, deal structure, so that the cash that you have to come up with is either none or negligible. The broker, they don't want to waste time with you. They earn money on commission. They don't earn a darn thing if they waste a lot of time with you, but you don't have the capacity to buy it in the first place. So the proof of funds letter is simply their way of eliminating the riffraff, of eliminating the folks that their experience is they would waste a lot of their time with. If you've truly mastered Bizar Financing, you don't need funds of your own to buy a business. We help you get past the proof of funds issue. And as you'll see from other programs we have where we partner with our members, where we do all kinds of things to support the buying process, one way or another, money is not going to be your problem. Knowledge may be, but money won't be. Resources may be, but not money. And we'll get you past the proof of funds question. Okay, number 7. What are some of the questions you must always ask a seller before signing a letter of intent or a definitive purchase agreement? We have a whole section on that in Bizarre Financing. That's not a quick answer. We have 10 questions. There's a whole thing in that section on how to buy a business that's right for you, where we talk about the 10 questions to ask a seller that not only work to get the answers to important information, but they're neuro-linguistically appropriate to have the seller believe after you've asked the question that you're the perfect buyer, that you have the money to buy the business, that by selling to you, you're exactly the buyer that they were looking for. Questions like, if I were to invest $5 million in the growth of the company after I owned it, what would I want to spend it on? So you didn't tell your seller, I have $5 million sitting in my pocket to buy this company. You just asked them a simple question. But in his mind, he goes right past, do you have $5 million to the assumption you have $5 million when he answers the question. Just simple questions like that improve your credibility dynamically in terms of getting concessions from the seller because they want you as the buyer. Okay. And yet you never represented for a half second that you had the $5 million. So there are questions that are just neurolinguistically perfect in that they provide the appropriate inspiration to move the transaction in the way that you want. And there are many other questions in there. There's 10 of them. You really need to learn those questions. I memorized them very early in my game and I worked them in. And the one question you can never, ever miss, and you ask it early in your meeting with the seller, usually at a point where everybody's comfortable or where it just is a natural segue to this question. And the question is a very casual, looking him in the eye if you're in person, smiling into the phone if you're on a phone with him. And you just say, John, how did you get started in this business? The seller will unload on you. He's been waiting all his life for somebody to ask him that question. He can't talk to his family about it because they don't want to hear that anymore. Nobody else is going to ask him the questions. His employees don't ask him. His friends don't ask him. He's proud of the answer and he's been waiting to tell the story. And you've ever started the building of your cosmic bond with that seller. The moment, the instant that you ask that question, you can sense it in the seller's demeanor. He could have been stiff and formal right up to the time that you asked that question. And if you asked it in the relaxed way that I just gave it to you, you will watch that resistance and stiffness melt. And all of a sudden, he is talking to you like you're his good friend. And the rapport that you've just built with the seller by listening. And then when he's finished, still listen. In other words, leave a pause at the end, silence, like you're listening. And then when you're sure he's finished telling you the story, you say to him, that has a parallel with me. And then you share something in your life that maybe hooks in to how he got interested in the business, how he started, the way in which he built it in the early days. And what that does is each thing that you're doing there is cementing that cosmic bond. Now, I can't tell you how important that is. I'm in the middle of a purchase right now. It's a $30 million. There were issues that the seller had when they sold the business. They sold it to me, not because I gave them the highest amount of money, but because I built this incredible cosmic bond with that owner. That person sees me not only as the buyer for his company, putting money in his pocket, but he's thrilled at the partnership we're going to have going on. He sees how together we're going to build a multi-million, perhaps billion-dollar company, how he's going to get to continue to run his business. He's going to have access to resources that he never would have had he not partnered up with me. And then we ran into this resistance where he had to close by a certain date. And if he didn't close by that date in his mind, he was going to lose substantially on something that he wanted to use that money for. We ran into problems. We couldn't get the deal closed as fast as we had hoped. There were challenges that we had to overcome. We persisted past the date for closing with his full and unquestionable support because of the cosmic bond we built. And then my ability on the back end to work through the difficulties, not only on our side to shorten the time beyond where it would have had I not done that, but I worked with him on the other side to get the reason that he needed the money lengthened to where we were able to get the whole transaction done. And if I hadn't built with that particular seller this incredible cosmic bond, that sale would have cratered, would have totally cratered. And so again, these questions that we train you to ask, they couldn't be more important. And please go in there to your sections on how to buy the right business for you. Go through those 10 questions and learn. What do you do when the owner keeps asking for more during the negotiations? Oh, I hate that. Oh, do I hate that? I'm not that kind of guy. Okay. But there are people that their negotiation is no matter what you give them, no matter what they say, yes, that's great, or how you cement what you've agreed to. The next day or whatever it is, they'll come back and they'll ask for something more. And then they'll ask for something more. and they never stop asking. They don't stop asking till you shut them down. Okay. It's like appeasers in between countries during times of war or peace and politics. You can't appease aggressive people. You can't. Okay. Because they'll just want more and as long as you keep giving, they'll keep taking. So you can't do that. You've got to know in your mind what's a fair deal. Okay, you got to have an absolute red line as to where you're willing to go and not, what you're willing to give up and what not willing to give up. And if the things that you are willing to give up, okay, what would you exchange that for? Got to be clear. You've got to be clear. And after you've made the basic deal with the seller, if they keep asking for more, this is what I do. I'll say to the seller something like, look, I'm sorry, but I thought we had an agreement on this. Are you saying that you won't do this unless you have this extra concession? And I put them on the spot for having to say to me, yeah, I need to have this or I'm not going to do the deal. Or I get them to say, no, I'm okay with the deal. They're okay with the deal. This is the deal. If they say they want more, I just say, look, I want to thank you for your time and your interest in working this out at me. You know what I'm willing to do. If that works for you, let me know. And I get up and I walk out the door. Now, if he stops me before I get to the door, great. If he doesn't stop me before I get to the door, I walk out the door and I don't call him back. All right. And if he doesn't call or she doesn't call me back, then I walk away from the deal because I'm not going to deal with something where it's constant takeaway. All right. So that's my way of handling it. You can have your own way, of course, but that's what I do, why I do it, and how I do it. Is it best to buy a business with real estate? And what if the business is relocatable? Okay. Again, it's a nuanced answer to the question. Buying real estate is a money intensive game. Okay. In other words, typically you have to come up with 10 or 20% down, and then you have the payments, of course, on the building. And there's a question as to would it be cheaper to rent that building or would it be cheaper to buy it? If the real estate comes with the business, I don't want my money tied up in real estate because my return is somewhat limited. I want my money available to build my company. So in that case, I will very often do a sale leaseback so that commensurate with my purchase of the business, I have sold the real estate to somebody who will lease it back to me. And I've used the proceeds from that sale through a double escrow to cover a significant portion of my purchase cost. But it depends how the real estate was valued. If the real estate, in my view, was overvalued, then I don't want any part of it because I can't sell it if it's overvalued and then lease it back. The person who has the capital to do the purchase lease back, they can't buy the building at a good price. They're not going to do it. At that point, I just leave it with the seller and I try to negotiate the best rental deal that I can with the seller and make sure that whatever the cost of the facility was to the business, whatever they were showing as a charge against earnings for the company, no more than the rent I'm going to have to pay. Because if it is, then that new rent is going to impede the profitability of the business that I'm paying them a multiple of for. I don't allow the seller to rent me that facility for any more than it was showing as a cost to the business before. The question here again is nuanced. And what if the business is relocatable? To me, relocatable or not is irrelevant to whether I buy the real estate. If the real estate can be bought at a great price and it doesn't impede my cash flow, I would buy it. Even if I was going to relocate the business, it's just a cash in, cash out deal. I'm just evaluating it on how much cash do I have to come up with? What's the value of that cash to me? Do I have it available? And if I do, then I'll look at real estate as part of the transaction, but only if it makes sense in the way I've already described. I'm not going to tie my capital up in the ownership of real estate. Return on real estate is never as good as it is on a good growth business. Now, a lot of businesses rent real estate and the landlord's making more money on their business than they are. That's not the kind of business I want to buy. And it's not the kind of business that you should buy either. You want to buy the business where your cash is leveraged and that little cash that you may have is leveraged to a mighty amount of cash through investors and lenders that come in and support your purchase. And through that, you want to increase the amount of value that you go into a business because on your leveraged money, you're going to get a much, much bigger return than you will on real estate. And when you got started buying existing businesses, can you recall some of the simplest ways to buy a business without experience or credibility? Some of you may remember my first purchase. I talked about it at length in Essentials. I bought a motorcycle parts company and the owner stayed on for a period of 6 months and he trained me how to run the business. And the education and training I got from the seller was worth to me in the end more than the business itself was worth because I became a business person, a whole business person through the purchase of that business. And remember, I built a cosmic bond with that seller. He was an older man. I was a young, ambitious guy. I built a rapport with him because he recognized me as a reincarnation of himself. He saw in me a young, aggressive, and capable guy that reminded him of himself when he was my age. He didn't have any children to leave the business to. And he saw me as the son he never had. And so he bent over backwards to accommodate me on the purchase of the business. And the fact that I was young, inexperienced, had no credibility, frankly, didn't bother him at any because he recognized my potential and was thrilled to be a part of helping me develop that potential. He was very comfortable with that. So was he an unusual seller? Yeah, that's not every seller. But if I hadn't been out looking at businesses, if I hadn't had the process of looking to create a bond with a seller so that they got to know me, like me, and trust me, then I never would have got this business. Right. So it starts with you having the right mindset. And it's an interesting thing about the universe we live in. We're all, in a way, sort of energy magnets, and we attract to ourselves those people who mirror the kind of energy and vibration that we put out. And you watch throughout your life the people who come into your life and the commonality that you have with them. And so if you get into this mindset that I just described to you and you start to exit in your vibrations of energy, you'll find that the right people are going to get attracted to you, the very people that you need to connect with, both as resources, as businesses for sale, all of those things. The universe is made up of energy. Everything is energy. Even what you call matter is still energy at the atomic level. And all that energy vibrates and all that energy attracts and repels things that are like and different. And once you get a sense of that, that there's something bigger out there than just the material you, and it works for you literally all the time. And once you get connected to that, you start to have a lot of faith that the right things will happen for you. So while it sounds like I had an unusual seller for my first purchase, yes, I did. But I truly believe the energy that I exuded and the very thing that his energy was seeking was somebody like me. I was seeking somebody like him. The vibration connected. And after that, the rest was destiny. To the extent that you understand that and see it, that'll really work for you. All right. Number 11. Do you have a method you use to determine if a business is worth pursuing or not during the first 15 minutes of your initial conversation? The answer is yes, I do. For me, it's easy. Okay. In the first 15 minutes, one of two things has happened. I've established some cosmic bond with the seller, right? We either are connecting and vibrating in harmony or we're not. If I'm not, I wouldn't care if it was a gazillion-dollar business. I'm probably not going to continue talking because why? Because my energy is being drained. It's not feeling right or comfortable for me. The seller and I aren't connecting. And if we can't connect in an initial conversation, how the devil are we going to connect when we have to really negotiate values with each other? All right. And I'm seeing that I would choose not to take a hard path to an acquisition when there are too many easy paths out there where once I'm in harmony with the seller, everything is going to go a whole lot better. So that's the first thing that I do. The second thing that I do is I want to get a sense of, is the seller impressed with me? If I can't have developed a significant impression on the seller of who I am, why they should sell to me, how I'm going to make this more profitable for them to sell to me than to sell to anybody else. If that isn't coming together in that first 15 minutes of our conversation, then I probably don't have someone that I can do a creative deal with who will work with me towards the nuances that are going to be necessary for us to get a deal constructed that I can do on a highly leveraged transaction. So that to me is the first part of the answer. Now, for other people who maybe don't get tuned in as much as I do on the cosmic bond side, if there are questions that I ask that tell me that this business has problems, that it has issues because of its industry, or issues because it has competition, or issues because it has internal conflicts, or for any reason that the business is having difficulties, I'm not a turnaround guy. I want to buy profitable businesses that are already headed in the right direction, that I can make bigger and better because of value that I can add to the business and add to a business that's already on its way to good, strong growth. And I'd rather pay more for that kind of business because guess what? If it's a great business, I can get investors who are going to want to be part owners of the business. I can get lenders who are going to want to loan to the business because it's growing and it's healthy. If it's got problems or issues, all those folks disappear. And it's just me standing there to buy the business. What sense does that make? Okay. I'm in the business of leveraging myself through other people. And so I want good, healthy, strong businesses that I can get investors and lenders to back me. Okay. And I don't look for the turnarounds. I don't look for the hard deals. I look for the deals that make sense I go in and compete with other people for the deal. I'll pay more than others might pay if I recognize the value, but I make sure that the value that I'm buying and that I'm recognizing is equally saleable to the investor and the lender so that I'll have their support to pay that price for that deal. And then, of course, I'm going to use seller financing. I'm going to use rollback investments of the seller back into the buying company. I'm going to use every leverage technique under the moon to get the deal done. But those are the key elements that I want to solidify in the first call with that seller. And usually that'll happen literally in the first 15 minutes. Number 12, what are some of the simplest and most efficient way to send cold emails to business owners and what to say? Okay, what we do here is we subscribe to a number of services. One of them is called Rocket Reach, which gives us the ability to go into the internet and actually find out. This is crazy, but they can find out who's asking questions in Google, who's asking questions on all the search engines that give them information about how to sell their business. What is their business worth? Everything you do on the internet goes into this big data. It's out there. Once you type something into a search engine, it's out there. Not only is it out there, it's connected to you. The whole world, if they knew who the connectors were, know how to get information that's connected to you that harmonizes with what they're looking for. So we subscribe to those services. And what happens is we're able to get the name of the owner, the email, what the questions that they were asking was. Anyway, we'll know exactly who they are and what we're going to do. And then we're going to have a simple email addressed to the owner that's going to have a headline that basically answers a question that they asked on the internet. Okay. What's my business worth? Our email is, you probably are wondering what your business is worth right now. And here's a quick formula that we use to price businesses that we're looking for. If this is of interest to you, contact us. Okay. So in other words, you want to tie yourself into as much direct information about that company as you can. And then you tailor the email to the right person, to the right email that you know they're using, to the right information that you know they're seeking. And in that way, your email is going to be very effective. If you can't afford that kind of big data access, then you can still do it by using LinkedIn and other places where these business owners hang around. You can use the tools of these platforms to send messages to those people. And again, you want to compliment them in your email. I heard about you. We understand you're a great manufacturer of widgets, and we're looking to acquire companies like yours. And we're a cash buyer and we pay top dollar. If you're interested, call us. It's the law of numbers. Get some callbacks. So that's just one way to go about that. Lots of others. We do cover them again in the sections on how to buy the right business, how to find it and buy it. Okay. What are some of the motivations that compel owners of profitable businesses to sell for no money down? And what are some motivations for distressed companies? I'm going to ignore this bottom one because I already covered that. We're not looking for distressed companies because nobody's going to help you buy it. If you got a lot of money and you're looking to use all your cash to buy a business that's distressed because you can buy it at a bargain price, because you believe with very little work, you can turn it around. That's maybe a different story, but that's not where we go and it's not what we recommend. So let's go with the top one here, which is motivations that compel an owner of a profitable business to sell for no money. The people who we buy companies from almost never know we're buying the company for none of our own money, because no money down in your mind, in anybody's mind, is you don't get any money down. I just make payments on the business. But we don't do that. We give the seller a down payment that's maybe equal to 30, 40, 50, 70% of the company. So they're going to get a lot of money down. But the fact that we're leveraging it all using their assets and cash flow, they don't understand that in most cases. They don't know that. So their motivation is simply to sell and sell as profitably as they can. And again, I like to buy companies with owners who appreciate me and my capabilities to make them money if they're my partner. Okay. So I sell them on the things I do and what I can do for them. And if they're my partner, how we're going to grow this business together and how I'll give them cash up front. They get to take all their chips off the table. Yes, they're going to leave some of their value in the company, but that value I'm going to make worth 20, 30, 50 times what they could make that worth on their own. And I sell me. I sell my capabilities. I sell what I'm able to do. Now, you may say, hey, you're Gordon Bizar. You can do that. You have all of this credibility and recognition on the internet. They can search you. Yeah, I got all that. So I go for very big deals with very high-powered entrepreneurs that end up being my partner. But you don't have to do it at that level, but you can still do it. Okay, let's say you're just a whiz-bang genius on sales. That's all you know, but boy, you could sell yourself to the moon. That's what you're going to sell them on. With me as your partner and handling sales for the company, here's what I did for XYZ company. Here's what I did for ZBQ company. I'm going to do this for our company together, and together with you handling the internals of the business, the administration and production, you've already proven yourself at that. Here's my track record for sales. Us two together, here you got your chips off the table. And with us two together, we're on our way to the moon. And you sell them on being your partner after you've leveraged their business and cash flow to give them the down payment on their business. So it's not that hard. And if you're not that talented at anything, whether it's production, efficiency, effectiveness, sales, whatever it is that you feel, look, I'm not that proficient, that might not be your method of buying the next business. But somewhere in your career building, I would make it a point to be an absolute ace at some necessary part of a business, because that gives you value to your business partners in the future. And that value lasts forever. So if I were in anybody's shoes out there, I wouldn't want to be a generalist, and I wouldn't want to be a party who isn't really skilled at some great aspect of a business. I would want to focus on something, specialize in it, concentrate on being the best that there is at it, and then using that skill sets to sell myself into partnerships with people who own businesses and where I can with them go to the moon. Just a thought. Number 14, what defines a small business? And should you walk away from a business because it's too small? In legal terms, a small business is any business under 500 employees. Okay. That to me is a crazy definition. I don't know why they use that as the demarcation point, but to me, I think of small businesses as businesses that make less than 10 million a year in sales. And for me, anything less than 10 million in sales, I walk away from, because if I look at the value of my time and the opportunity cost of negotiating with them, trying to close the deal, have deals not close, and crater for whatever reason, I walk away from them. I'm better off. Okay. My time is better off spent on bigger deals. One, I get to work with people who are more sophisticated, who will be more inclined to work a creative deal with me because they'll understand the creative aspects of a deal. I'll be able to get investors for the deal because nobody wants to invest a little tiny bit of money in the purchase of a small company. The bigger the company, the more exciting it is to people who have money. Investors and lenders want to make a lot of money. They can't make a lot of money on a small deal. They can make a lot of money on a big deal. And so they're going to be much more excited, much more collaborative with me if I'm working on a big deal. So again, if I were in your shoes and I was taking Bizar financing course and I was going to really put the work in to become a real expert in terms of the methods, techniques, strategies, structures, then I would expunge from my mind that I'm going to look at a business under 7 million in sales and start looking from 10 to 20 as maybe my first purchase, because you're going to have all the knowledge to do it. Business will be big enough to attract some of the good capital. But believe it or not, life gets really exciting when you go for 20 to $60 million businesses, because now the banks want to talk to you. The insurance companies want to talk to you. The pension funds want to talk to you. The mortgage brokers want to talk to you. Everybody wants to talk to you because everybody wants in on a big deal. Okay. I think I gave you the lines of demarcation there. Number 15, how do you determine if you're buying the assets or shares of the business? That's really a simple question to answer. There are only two kinds of purchases of a business, technically. One is an asset purchase where you're not buying the business, the entity. You're buying all the assets of the business that enable the entity to do the business. So if you're buying the assets, all you're buying is the assets. The person who's selling still owns their entity, but they gave up the right to conduct the business because that's part of the assets that they sold to you. So if you're doing an entity purchase, you're buying the LLC, you're buying the corporation, then that's an entity purchase and you're buying shares or percentages, shares if it's a corporation, percentages if it's an LLC in the business. If you're buying the assets of the business and the business stays, the actual entity stays with the seller, then it's an asset purchase and they're taxed differently. And there are things you should know more about than we're discussing here to know whether you should be doing one or the other. Okay, number 16, one popular technique you mentioned is roll up several businesses of the same type. But how do we find out what sort of groupings of businesses might be in demand? And how do you find individual companies in the grouping which are for sale? I covered a little bit of the how do you find businesses for sale when we spoke earlier about what do you send to them in an email? How do you get their names and all that? That same situation really applies here in terms of how do you find them. Also, we started using business brokers because a lot of them now are a lot more professional than they were many years ago when I used to shun business brokers. But there are good professional ones out there. They are helpful. They do a lot of pre-screening. They help the seller, if they're good business brokers, to really understand the value of their business, to understand a sophisticated deal when the seller might not be sophisticated when it comes to the buying and selling of the business. They might be very sophisticated in the operating of the business, but not in how it's structured for sale. So they can be really helpful. When you work with them and you build a cosmic bond with the brokers, they want to get the buyer to you because they have confidence you're going to close your deal. and they don't earn money on a deal that doesn't close. So they want to get that seller in the hands of somebody who's a real buyer. So building rapport with business brokers is a really important thing to do. Now, in terms of the roll up, when you buy businesses that are of the same type, you got a lot of people in any given industry who have built companies to a certain size. They're selling them because they want to retire. They're good businesses. The market isn't really strong right now, and this is an excellent time to do roll ups. What I do is I look for my first business to be what I call a platform company. In other words, a first purchase in a field, I want that company to have good internal management, to have already done the things it needs to scale the business. In other words, they reduce their business down to standards, to forms, to processes that are repeatable over and over again. And the business is not conditioned on having superstars in the business. The business is conditioned on having mastered all of the processes of their business, from sales to production to whatever it is, and that their business is already scalable and well managed and growing currently. That's going to be my first purchase. Then my second purchase, the third and fifth and 10th and 20th, is going to be owners who want to retire, whose business hasn't scaled, isn't scalable, but I can now acquire them because they're not very profitable. I can acquire them for reasonable prices. I can roll them up into the platform company, which can now manage them, take them over, put in the processes and all the scalable tools, and very quickly bring that acquired company up to a higher level of profitability and make the company worth really relatively quickly a lot more than I had to pay for it. And that process, every time you acquire, you have more efficiencies or economies of scale. Your profit margins go up, not only for your existing company, but for the company you're acquiring. And if you've got a good growth plan and a good platform company, everybody wants to invest in you. Everybody wants to loan you money. Everybody wants to get a piece of your deal because you're on your way up and everybody can see that your plan is sound. Okay. So those are the ways that I generally approach that. All right. As a beginner, how important is the balance sheet? Should it be part of the initial conversation with the owner? My initial conversation with the owner is never about assets, never about business numbers or finance or profit or cash flow. I've already received enough information in what's called the CIM, the Confidential Information Memorandum, which the broker in most cases is going to have provided me on a business of the sizes we're talking about. That's the next point of a bigger business. The brokers and the people who are selling them are more sophisticated. They're going to have gotten all the information that a buyer is going to want to know. They're going to have packaged it in a way that it's easily digestible. So I'm going to know all of the basic numbers of the business before I talk to the seller. And so the only thing I want to do on that first meeting with the seller, frankly, is build cosmic bond. I want to leave that meeting having established a bond where we like each other, trust each other, and respect each other. And maybe not to the moon of those things, but we've established the beginning. We vibrate on the same frequency. We have a comfort factor in talking to each other. They find me easy to talk to. I find them easy to talk to. See, all that is where I want to go with this, because now we're winning their hearts and their souls. If we win their hearts and their souls, the pocket will follow. Business will follow. Okay. So that's how I spend the first amount of time. And then the balance sheet is the least important part of the company. The most important part of the company is the P&L, the profit and loss statement, because the balance sheet may give me an insight into assets inside the company that'll help me in the financing of the company with asset-based lenders and the like. But the P&L tells me whether I want to buy the company or not, which is the idea that it makes money, that it has cash flow that can pay off that I incur in the purchase of the company. So the balance sheet is actually less important to me. The real important part to me is the P&L. Okay. But they're both important, but I don't get into them on the first call. When I get into them is at some point, we love each other. We've enjoyed talking to each other. They already know some of my plans for their business and how I'm going to build that business. And if they're going to stay on and they want to work with me, how I can work with them and resource them and support them in the growth of the business, give them a double bite at the apple, giving them cash up front, giving them a buyout on the backside, all of which they can get excited about. That's my first conversations with them. After that comes the balance sheet and the P&L, because we're going to ask them at the end of that conversation to supply us with all of that if we haven't asked them already. There's a thing called a data room, it's like a depository electronically where all their documents get filed. They give us access to that. We go in and look at all that stuff and put together our letter of intent, which in effect is our offer to them. Okay, I got to move on because we're running late. Last question. What are your thoughts on buying a business out of bankruptcy? That's a fast and easy one to answer. I bought a business out of bankruptcy. It was hell on earth the first 6 months working to get it bought, to get it turned around, and to make it profitable, which we did. Okay. I did it once. It was part of a big win for me. Okay. But I would never do it again. And the reason I would never do it again is because too much negative energy had to go into getting that stuff all turned around, making deals with creditors, all the things that you can do that are big wins within the turnaround of that business. I mean, big wins. You take somebody that had a loan to the company of, let's say, $10 million, dollars, like one of their asset based lenders might have had that big a loan. I'm going to negotiate them down, depending on the situation, down to maybe 2 or 3 million. That's all they're going to get. Okay, even though they're secured lenders, because the company went bankruptcy, I'll guarantee you half their assets aren't there anymore. Okay, they won't. And the liens against those assets are not worth what the loans are, not even close. And so I'll negotiate that all down. And by the time I'm done, I'm going to have a good buy. But it's work, man. That was work. And the level of profitability was long in coming. It took a while. Had to go out and turn customers around to trust it again. A lot of work had to get done. So anyway, I don't recommend it. I recommend going after the highly profitable companies. It's positive energy all the way through. You don't have to convince hard lenders and investors to go with you. It's just a much better approach. And most people don't do it because they just don't think they have deep enough pockets to go after the bigger profitable companies. And it's exactly the reverse. You know how to structure the deal. You have other people who have money who will want to back you because they want a piece of the action on this great company you're buying. All right. I'm sorry we are not going to have time for a lot of questions here, but I see a couple. So let me just click on them and see if I can answer them again really quickly. What are some of the post acquisition steps that happen after doing an LBO? The post acquisition steps aren't any different than doing any other kind of purchase. You already made your finance deals. All of your payment structures are in place. You got to make the payments on your debt service. And other than that, there's not a lot of difference. Everything else is you're taking over the business. And if you've taken it over where you've retained management, nothing on the day after is going to change for what was true the day before. Everybody's still doing the same thing that they were doing. And little by little, you actuate yourself into the business to make sure that all of the control elements that you put in place that were part of the closing. For example, the old seller's names off the bank accounts, and maybe new bank accounts have been opened up and the money transferred to the new bank accounts that only allow you to sign the checks, for example. So there are certain functionary things that happen after the close that are the process of really taking control of the business, but they're not very big. That's mostly handled by attorneys, frankly. They're the ones who set all that up. And so you're not going to be doing anything different, except now you're there, you're having meetings with the seller, and they're building the business, and you're getting clearer and clearer on the growth path you're going to be pursuing together. Okay, I'm going to take one more question here. Hi, Gordon. Is the proof of funds letter you spoke of, is it in the resource section of the Pro program? You won't find it anywhere. In other words, there's no place that we publish it, what it looks like. And the reason we don't is we don't want it to be a document that everybody on the planet knows what it is and what it looks like. When anybody wants one because they've got that issue, all they have to do is call us. We'll ask them a few questions and we'll send them a letter literally tailored for the particular party asking them for the proof of funds. All right. That's it, folks. I want to thank you for your enthusiastic presence here today.